last-minute technology issues, so he decided to go for the cost rather than finance. Thank you very much for coming in. Welcome you all to the meeting. We started very badly last week, but then have a good. We are very good forum this morning. We have over 50 people attending this conference, the first ever finance professional forum conference. We have some last-minute cancellation that Takaful couldn't come because of some government work. Today only his office volunteered. Ambassador of Pakistan also expresses this meeting couldn't come also. He got banned because they have some important meeting from Pakistan. Punjab is calling for some meeting, so he also couldn't attend. But they all have given us a good wish messages and they say very good luck, and they wish that we keep on going with our efforts to promote finance professional company. Abbas Rabi, our chief guest now, and he is here. Thank you very much, Abbas, for coming here. The chairman of Bahrain Accounting Association, and we all very delighted and honored to have him here. Quickly, the agenda. We are late, but we will catch up as we go. We will have a speech from Mr. Abbas Rabi, and then we go with the first presentation. Noman Bashir will tell us about accounting issues. So I will ask Mr. We have to skip. Now we ask Mr. Abbas Rabi, please word and have some.
Good evening. It is a great pleasure to stand in front of you to participate in the event. I think this is the first event for 2014. And we at Bahrain Accounting Association, and also in Bahrain Accounting Profession, we always encourage this kind of forum, and whether we are here or no, we give you all our full support and appreciation for such event. I have made a little speech. I don't want to bother you and bore you with it, but I think it is good to record in such event our thought and to shed light on some other aspect of the, and we still shed some light on other aspects of the finance profession. Please, the current economic scenario warrant proper. The current economic scenario warrant proper accounting and financial analysis and financial appreciations. We as accountants should have the ability not only to add and subtract number, we should have the ability to understand numbers and to explain numbers to others. In other words, what is the meaning of the financial data that we analyze? One of your topics is on valuation. Valuation is very important topic nowadays, and fair value accounting is the hottest on these days. And I know a lot of our colleagues from Pakistan are good in concluding and getting qualified with the CFA qualification. This is one of the most important tools nowadays and one of the most prestigious, and talent like these are always welcome in a market like Bahrain or the GCC countries. Any entity financial position or statement of financial performance or statement of cash flow and note to the accounts will only provide most of the historical data and information about what has happened in the past. But to pass an opinion or to make use of this financial data, it will need a financial talent like you guys to understand it and to interpret it to the management and to the owner and whoever stakeholder. Also, the director report will carry some information and provide a lot of talk about the future plan of the company. A layman person will not understand what all these data about. But with the help of talent, accountant talent, and financial analysts, these data will make some meaning. So to facilitate the easy analysis of financial data, experts have evolved techniques and use the help of so many techniques. The most famous one is the ratio analysis. And also, nowadays they use industry benchmark. And all other methods or measures to enable proper group comparison and so on. All these, they are simple. We learn them in the textbook, maybe in the university and in our professional education. But I am re-emphasizing this to tell you nowadays, at this stage of each one of us professional career, these are the tools that we have learned and heated the time when we were in the university, second year university or third year university. We heated the time that professor or teacher made us memorize them. Now, everyone will know what the current ratio means, or the return on or price earning ratio of a share. What does it mean? In those days, we thought it was just kind of punishment that finance professor asked us to memorize. I don't want to give you a little test and ask you what is the current, how to calculate the current ratio or the asset ratio, but I'm sure each one of us nowadays at the maturing stage of our professional career, we appreciate and understand. At a glance, we will say this company is liquid, or this company has a good book value, or this company, its debt ratio or gearing ratio is dreadful. So accountants, auditors have always played a key role in the economic and financial arena, not only for the nation and the multinational, and not only for the national companies and the multinational companies, but also help businessmen in their key decisions. What we have been what I've been trying to say, all these ratios and all these comparative techniques or performance measurement techniques will help the management in making important decisions, will help in the key decision process, and your input will facilitate a decision whether to buy or sell, to liquidate or to continue. What are the challenges faced by the finance and accounting profession these days? Because this world is ever-changing world, or the status of the economy is ever-changing. This means that I have to share some of my views on the skills and challenges faced by the accountant today. In particular, those mature people like me who are acting as advisors or changing from audit and bookkeeping to, say, become consultant. And auditor and consultant are always like mouse and cat. Each one tries to catch on the other. So, it is no longer appropriate to merely report the number. We auditor only report the number and historical number. But our friend, the consultant, has to make a useful meaning of these numbers. So his client and his management will appreciate it. Therefore, to succeed in this work in these days, finance and accounting professional like you will need to widen their skills. This goes in particular to the two most important areas. The most important areas, and nowadays even in our professional examination, are concentrated on. One is communication skills. We as a human being need to communicate, but as accountant or finance professional, we need to communicate more effectively and efficiently. Not to give a large speech or a long speech like mine and only think to say that you accountant or finance professional need to communicate effectively and need to know how to analyze and interpret data. So we need to communicate effectively and efficiently. And also we need to use our skills to analyze data and to be able to produce financial reports that are understandable to public, has a meaning, so business leader and the wider community can appreciate what we are doing. In conclusion, I would like to emphasize that being a finance professional or a public accountant, it is not just about number crunching. Our clients today demand us to act as strategic business advisor. And more than that, need us to take hand and walk with them hand in hand to help them take strategic decisions. Our responsibility is to maintain the skills and technique to act as a modern business advisor and to relish the opportunities to help our clients meet the new challenges. I would like to conclude by thanking you all for taking the time to listen to my little speech, and thank the organizer for their effort And God bless you all. Thank you.
Accounting Association is a flag bearer for the development of finance and accounting environment. It's probably the only organization who's actually carrying on this role by themselves. Maybe some of us don't know about that. There is a certificate program which is being conducted by Bahrain Accounting Association. It's called International Certificate in Finance and Accounting. I will be circulating the information about that if somebody is interested in this. And then I will give the contact details so you can contact. The purpose of our forum is to create a massive networking between the members. The strength of any community lies in the network and not just the knowledge. Knowledge we all have, but not independent individual knowledge sometimes is not that effective, which is as compared to the collective knowledge. And the purpose of our forum is to join our knowledge base, create a competitive advantage over the finance bodies that is prevailing here. I would like to start our first presentation on Takaful. I will request Mr. Noman Bashir to come on board.
Assalamualaikum. Good evening, ladies, gentlemen, and lady. I see a lady as well. And thank you very much for having me here to share my thoughts on a subject that has, over the years, become pretty close to my heart. Before I go into the presentation, I'd just like to congratulate the organizers in achieving this first ever event and managing to bring us all together under this one roof, pulling us out from our daily lives and having us here. It's no mean feat, it's an achievement in itself, and I hope that these events continue to grow, allowing us professionals the opportunity to share our thoughts and to share our experiences with each other. So, just a quick introduction. My name is Noman Bashir. I work for Ernst & Young. I lead their Takaful advisory practice, and I'm also the co-author of some of their Islamic finance industry reports. So I lead the Takaful report. We publish this annually, and we also work on the Islamic banking competitiveness report. If any of you have not received these reports, please do get in touch with me at the end of this session. I'll be very happy to share soft copies with you. The objective of today's presentation is to introduce to you the concept of Takaful and to try and explain how it differs from conventional insurance. Now, if I put anybody to sleep back there, somebody just give him a nudge and get him to open his eyes up for a bit. This won't be too long. And if I am not loud enough, please let me know. Now, every time I give this presentation, I recall an incident back when I was doing my MBA. We had invited an Islamic finance expert, a product manager from one of the leading banks back home, the Mizan Bank. And this gentleman was going to do something very similar to what I'm trying to attempt today. It was to explain the rationale behind why Islamic finance is required, why it is different or how it is different from conventional. And unfortunately, I remember that, I was one of the loudest naysayers and I gave that gentleman a very hard time. Back then, I was not in a position to actually understand the nuances of Islamic finance and therefore could not comprehend the message that the gentleman was trying to convey. I hope the same fate does not meet me today, and we end this session by myself sharing some real insights into the industry and also sharing what the core concepts behind this of the Takaful is. So before we begin again, how many of you have heard of the Takaful, and how many of you have some idea of what the Takaful is? If I could have a show of hands. Okay, so I see at least 10 people, right? And how many out of these 10 people believe that there is a fundamental difference between Takaful and conventional insurance? Okay, so 4 out of 10, 40%, better than I've seen at other conferences, so maybe things would be a little easier for me today. But by the end of this conference, by the end of this session, I'm hoping that we'd have more hands up on both these questions, yeah? Okay, so starting off, life is full of risks, especially if you're a consultant. Risks are all around us, and people manage these risks in very different ways. So there are those that avoid any sort of risk mitigation, although in today's day and age, such people are few in number, but still, there are many of us think that everything that happens is just because it is destined to happen. There's a misunderstanding around tawakkul. Tawakkul meaning that destiny has been written out for us, and there's not much we can do to change it. Therefore, there's no point in us mitigating our risks. There are others, like my wife. She's a self-insurer. She saves up for the rainy days. She hasn't done too good a job at it, but nevertheless she's trying. There's the insurance or conventional way of mitigating risks, and this basically we'll discuss why I'm saying that this is a commercially viable yet ethically flawed concept, but that's how we look at it, us Islamic finance practitioners. And then there is the Takaful concept, which is what we call the Sharia compliant and ethical version of insurance. Some very high-level terms that you would hear about if you're talking about insurance. There's a policy. It's a contract that the insurer and the customer put in place. This basically defines the arrangement that you have with your insurance company, when exactly your loss is going to be compensated by the insurance company, what terms and conditions apply, premiums and contributions. The premiums and contributions, these refer to the annual payments or monthly payments, depending on your policy, that you pay towards this insurance policy. Many different types of insurance. There's life, there's family, property, casualty, medical. Some of you have heard these concepts, some of you haven't. We'll try to just go through some of the more relevant ones during the presentation, and if there are any questions regarding something in particular, I'd be happy to take these up. And then finally, right at the bottom, there is certain key performance indicators that insurers and Takaful operators use to measure their financial health. So, not sure if you would be interested in some of these, but just a list, used by insurers and Takaful entities to measure their financial health. Let's talk about insurance. So, generally, what happens in an insurance contract is the customer will pay premiums to cover himself against a specific risk. Let's say car insurance, you're paying an annual premium to mitigate any accidents that you might have. In other countries, you mitigate the risk of having your car stolen, vandalism. The insurance company calculates premiums using actuarial methods or statistics, probability. So basically, the insurance company is trying to calculate if there are 100 people that are going to pay premiums this year, how many of those 100 are actually going to get any sort of accident, or how many are going to file claims, what would be the amount of that claim. Depending on this, they price their premiums so that after paying all the claims that come in, they have a hefty bundle of cash in their pocket. The customer, in return for paying these premiums, is entitled to make claims when these losses occur. And the insurance company is bound to pay these claims whenever they occur, whether there is money in the kitty or not. Any surplus after all payments have been made is profit, and any shortfall after these payments have been made is a loss for the insurance company. Now, the important point to note here is insurance, the company's gains are actually dependent on the losses of the insured or the customer. So if the customer is profiting or benefiting out of the insurance agreement, it is the insurance company that makes a loss, and if the insurance company benefits, then that means that the customer has paid premiums for no reason really throughout the year. Now let's talk about some Sharia issues with conventional insurance. The thing about Islamic finance, I find that a lot of my colleagues, my friends, they're not able to see the key difference between Islamic finance and conventional, because they don't understand why conventional is wrong. Everybody knows that conventional is not allowed by Sharia. But why exactly is it not allowed by Sharia? So let's see if we can, just try and get some thoughts on what the Sharia stance is on conventional insurance. Now, there's nothing wrong with the concept of insurance in Sharia. It's actually the practice of insurance where Sharia raises concerns. So what are these concerns? Obtaining an insurance contract is a sale-purchase transaction. It's a commercial transaction. If you go to an insurer, a conventional one, and you take an insurance policy, you're actually conducting a sale transaction, a conventional transaction, a commercial transaction, sorry. And this commercial sale transaction is subject to all Sharia pronouncements on a valid sale transaction. Now, some of us will know what these Sharia pronouncements are, but just 2 or 3 from the top of my head. When you're making a sale, Sharia requires that you ensure that the asset that you are purchasing is, it's clear that this is what I'm purchasing. You have a clear price at which you are purchasing, and you have a very clear time frame in which the transaction is occurring. So these are some of the 2 or 3 very top level rules that apply to a valid sales transaction. And there are many more, so about 10 or 13 if I remember correctly. And if anybody is interested in the whole list, I can share them after this session. Now, premiums belong to the insurance company, and these premiums are invested in all sorts of investment avenues, some of them being interest yielding. So there's no bar for a conventional insurer to invest in interest yielding activities or activities that are prohibited by Sharia. For example, cinema, alcohol industry, etc. The insurance company then pays any claim from its own pocket. These are the 4 or 5 things that you would expect in any insurance undertaking. And hidden amongst these 4 or 5 steps above are riba, kimar, maisar, gharar, and exploitation. In English, you would have riba or interest. Then kimar and maisar is basically gambling and speculation. Gharar is very high levels of uncertainty, and then exploitation is exploitation. We'll try and identify where exactly uncertainty, gharar, and riba are hiding in this conventional transaction. But almost all of us know that Sharia prohibits all 4 of these. So now it's time to see where these 4 are hiding in an insurance transaction. Now, if an insurance company takes out premiums and invests in interest yielding avenues, so obviously there's riba or interest involved. So that's that's what every one of us will recognize immediately. But then there's also another type of riba involved in insurance. Imagine you paying 100 dinar for your car insurance. Now, you're paying 100, and if, God forbid, something happens to your car, you're probably going to have the insurance company repay you maybe 10 times the same amount. So let's say if it's an accident, I had the misfortune of going through one myself. So my insurance is like 200 dinar a month, 200 dinar a year, and the insurance company paid about 3,000 dinar in damages to my car. It was Takaful, by the way. But the thing is that this 3,000 was over and above the 200 that I was paying. Anything above the principal is riba. So this is a form of riba that not everybody spots, very easily. Gambling and speculation. Where is the gambling element here? We mentioned one party's benefit is another party's loss. Now, an insured a customer, he pays a small sum of premium. For example, myself paying a small premium to get a car insurance, hoping that if an accident occurs, then the insurance company will make good my claim and give me a big sum that I can claim. So the customer pays a small sum of premium, hoping to make a big sum on a claim. Total loss of premium in case the claim does not occur. So this is gambling. I don't say that. Sharia scholars say that this is gambling. You're gambling, speculating that the 100 dinar or 200 dinar you're paying will yield 3,000 dinar down the line. And the company, insurance company, is also gambling. They're gambling that the insurance premiums that they are accepting will not only cover their losses but also yield a surplus that will form part of their profit. Uncertainty. Another element hidden in insurance contracts is uncertainty. The insurer doesn't know how much he will owe at the end of the year. He doesn't know for sure how many claims would come to him. The insured or the customer doesn't know how much he will ultimately pay. Now, I can pay 200 dinar, but at the end, if I have an accident, I will be paying negative amounts of money because the insurance company will be paying me back. So the customer doesn't know how much he is actually paying. Finally, the time of payment is not specified either. And now these are extremely important elements of any commercial sale contract specified by Sharia. The word exploitation there is missing. Oh no, it's there right at the top. So exploitation is exploitation because an insurance company is incentivized to price itself as high as possible, because an insurance company knows that whatever is left after all claims have been paid contribute towards its profit. So the insurance company would be tempted to price itself to exploit, to price itself so that there is enough in the premiums to cover the cost and also make a hefty profit. Let's look at the Takaful and let's see how this concept differs from conventional insurance. Before we define the Takaful, a general conception is that the Takaful is a recent concept. Well, actually it's not. The Takaful has been existent in some way or the other for generations, and since the Prophet, peace be upon him's time, in a slightly different format, but we'll come to that. Just a small example, we are not to confuse risk mitigation with tawakkul. There's a hadith or a saying from the Holy Prophet, peace be upon him: tie the camel and then submit to the will of Allah. Meaning that you do what you have, you do what you must do, and only then, after you've done the necessary and taken the necessary precautions, you can submit to the will of Allah and let destiny take its course. very similar concept of Takaful used to exist in pre-Islamic times as well and continued through the Islamic era. It was the concept of Akila, a risk-sharing mechanism whereby community members pooled their share of blood money. So the word Takaful is actually taken from an Arabic word, kafala, which means to guarantee. Through inflection and time it's changed to takafala, which means to jointly guarantee. And the concept is very similar to Akila, and this concept was practiced during the peace be upon its time. There are origins of this concept in the first constitution of Medina, and in some way or the other, the concept of Takaful continued during the Abbasid and the Ottoman period. Serious efforts toward modern day Takaful were made in the 1970s, and surprise, surprise, Sudan was the first country that actually launched the Takaful operation. This was somewhere in 1979. Sudan, mind you, is a recognized pioneer in Islamic finance. The concept of Takaful, it's a risk-sharing system. It's not a risk-transferring system. I'll try to explain this in a bit more detail later on. But by risk transfer, I mean, if I take an insurance policy, I've transferred my risk onto the insurer. But so if anything happens to my car, it's the insurance company that's responsible. This is slightly different in Takaful. In Takaful, a group of people join and contribute towards a common fund, and then this common fund is used to mitigate any losses that are occurred by participants. So some key principles there you would see in Takaful. There's cooperation. Essentials of Islamic contracts are adhered to. The Takaful fund, which we'll discuss in a bit later on. But there's a legal entity called the Takaful Fund, which is very different from the concept of insurance. Then there is a huge difference between the way insurers use their funds and the way Takaful entities use their funds. The treatment of profit and loss is very different, and conditions of compensation of damage are very different. A simple Takaful process is a Takaful operator creates a Takaful fund. So you have a Takaful operator. This Takaful operator has shareholders. These shareholders have commercial interests. However, these shareholders and this Takaful operator sets up an independent Takaful fund. And there are different mechanisms by which you can do this. But this fund is basically a donation fund, a voluntary fund, in which different participants will pool in their money, and this money will be used not to form profits for the Takaful operator or the shareholders. This fund will be used to actually make good any claims that are lodged by the participants. So there's a new entity here, the Takaful fund, which wasn't there in insurance. Okay, and this fund is basically used to pay the claims. So let's look at this in a little more detail. Your participants, all of us, anyone that has taken a Takaful policy, will contribute, make payments. They're called contributions, and these payments will be pooled into the Takaful fund that we talked about. The Takaful operator, which is a separate entity to the Takaful fund, the shareholders, the commercial entity, will use these funds to invest them in Sharia compliant investment avenues, and they will yield profits to add on to these pool of contributions. From these pool of contributions, the commercial entity or the Takaful operator will take out its own fee for managing the fund, for looking after Takaful participant concerns. This we refer to as wakala fee. There are a number of different types of fee that can be taken out, but the objective here is to let you know that from these contributions, the shareholders or the Takaful operator will take out their management fee. From this fund also, the operator will minus all the claims that come in. And then from this fund, it will use certain proportion to go into Takaful. Takaful is basically where the Takaful entity is again seeking Takaful protection from another company. Anything from the surplus after the wakala fee, the claims, the Takaful expenses have been deducted is the surplus. Now insurance companies claim this surplus for themselves. This surplus is basically for the insurers a profit. And any loss here is any shortfall here is a loss for the insurer. For a Takaful operator, this surplus is not a profit and it's not a loss. This surplus is a sum of donations and it belongs to the participants, not to the Takaful operator. This surplus is then used to build up contingency reserves, again for bad years in the future. It is also used to make charitable donations, and finally, some Takaful operators use this surplus to make distributions among participants. Now you might have noticed some very key differences between conventional and Takaful. One of the key differences is that whereas conventional is based on a sale contract, Takaful is based on a non-commercial contract. It's a donation-based contract or a tabarru contract. Therefore, on Takaful, a lot of Sharia rulings on a sale contract do not apply. Why do they not apply? Because if it's a donation and if you're not expecting returns from it, then the uncertainty, gharar, speculation, gambling, all those elements are taken care of. In insurance, we discussed that premiums belong to the company, whereas in Takaful, these premiums belong to the Takaful fund. In insurance, the company pays the Takaful. In insurance, the company pays the claims when they occur, whereas in Takaful, it is the Takaful fund or the combined pool of resources that pays the claims. And finally, riba-based profits are genuinely expected from insurers, whereas the Takaful operators make sure that their investment profits come from Sharia-compliant means. So, in the Takaful, you would see the concept of risk sharing rather than risk transfer. In Takaful, you will see the concept of wakil or agent. That's the shareholders of the Takaful operator. His contribution towards managing the fund and managing the participants as an agent. Whereas in insurance, the insurance company is actually a guarantor. In Takaful, you have an ameen or trustee of the fund, whereas in insurance, you have an owner of the claims, owner of the contributions. Takaful, in our eyes, is ethical and fair, and I hope there are not too many insurance company execs sitting here, but insurance, in the eyes of many, is exploitative. Right. We're going to go into a bit more detail, I hope you don't mind. We're going to talk about Takaful models. There are different Takaful models. So the practice that we've just seen right now is put into implementation through various different types of models. But before I get into that, how much time do I have left? 10 minutes, okay. So, one of the older models, the first ones that came into being was the Mudarba model. In the Mudarba model, this is something that was heavily practiced in Malaysia, not so in other parts of the world, but in the Mudarba model, the key difference here with what we have today, contemporary models are usually the hybrid model and the wakala models. But the key difference between those and this one is that in this model, shareholders are allowed to take into their income part of the underwriting income. Now, to explain what underwriting income is, remember when we talked about the difference between claims and the contributions? So that's basically your or the surplus is basically your underwriting income. Now, most Sharia scholars don't think that this model is 100% Sharia compliant. Therefore, this model is not very widely practiced anymore. There are few Takaful operators in Malaysia that still adopt it, but here in the GCC, you have something called the combined model, and in Pakistan and elsewhere in Dubai as well, you have the Wakala model. These two models are, majority of Sharia scholars believe that these two are, more strictly in line with Sharia rulings. I don't think I have time to go through each one of these in detail, but anyone interested can, let me know after the presentation. There are different types of Takaful propositions. There is a family Takaful, there is a general Takaful. Each one have different types of products. If anybody is interested in buying any, I can explain some of these to you. I'm not a Takaful sales agent, by the way. I work for Ernst & Young. I have my business card with me just to prove the point. But let's talk about challenges. A 1 minute crash course on challenges. The Takaful industry, one of the key challenges that it's facing is that regulatory support in a lot of these Muslim majority markets, which are usually considered hubs for Islamic finance, regulatory support is still evolving. And because this regulatory support is evolving, Takaful operators sometimes find themselves at a disadvantage when they are operating as compared to conventional. There are a number of other challenges as well, but one of the key ones again is perception. So a lot of our core market doesn't understand or appreciate the difference between Takaful and conventional, and therefore the value proposition in the eyes of many is not that clear. When will this become clear? When, the best thing that can happen to Takaful is when people start realizing that it is starkly different from conventional insurance. Not many people are convinced that this difference exists today. But I just wanted to show this picture to you. What does this look like? Fahim, what does this look like? Well, okay. When I saw this, it looked like what we call back home a tonga, a horse carriage. This is a car, but this car was made very close to resemble very close to what horse carriages were in Victorian times. That's because modes of transfer back then were the horse carriage. So when something new came on the block, that's the car. They took inspiration from the next closest thing that you had, which was the horse carriage. Again, a horse carriage. But today your car looks like this. So after about 100, 200 years, the car has evolved from looking very close to a horse carriage to something like this. Not every car looks like this, mine doesn't, but there are cars that look like this. The point I'm trying to make here is that I'm quite confident that give Takaful and Islamic finance a time frame, and you will find that the differences between insurance and Takaful become very, very stark, very unique. Okay, last 1 minute of my speaking time, and then I'll have a few questions. We do the Global Takaful report every year, and I've just chosen a couple of slides from that to give you an idea of the industry. It's an $11 billion industry. When I started my work with Ernst & Young, it used to be a $3 billion industry. So it's tripled over the last 5 years. It's still growing at 16%, and it has grown tremendously at 30% over the last 2 decades almost. The major chunk of the Takaful contributions come from Saudi Arabia. GCC overall is a big hub, and also the Southeast Asian region comprising of Malaysia and Indonesia are another big hub. Within the GCC, Saudi Arabia forms 77% of the Takaful contributions. UAE forms about 16%. And within the Southeast Asian region, it's Malaysia that has about 71%, whereas Indonesia has 24%. Just to give you an idea of the key hubs for the Takaful. Now, I'll stop myself here and let me see if anybody has questions before I have a question at the end. Yeah?
My question is, how much time do you need to explain us the Takaful models?
Right. The Takaful models. Maybe 15 more minutes? 15?
I don't know whether everybody...
Don't hold me to that. It might be 20, but I'll try to do it in 15.
Because this is very important. The Takaful models is the core of all whatever you have discussed. So if you don't discuss the Takaful models, probably you have left 50% of the information out.
Okay?
Do we have any other questions on the floor? Yeah. So because if you don't have the floor, then we have 15 minutes and we can allow them to go to the top of the Alright? Okay.
So are we going ahead with the models? Right, let's start with the Mudarba model. You have what we discussed as the policyholders fund. You have the policyholders that make the contributions into this fund. And then you have, let me see if I can stand somewhere. Okay. Somewhere there is the Takaful operator. And if I haven't kept him there, never mind. So your policyholder fund, that oval in the middle, is actually where all the action is. Your contributions will add to this. Your shareholders will also contribute something called a Waqf donation or a Karde Hasna. Different regulations require different treatment. In the Mudarba model, it is generally a Karde Hasna. So basically the Takaful operator provides some seed money into this fund to get it up and running. Now the policyholders fund is used to make investments and earn investment income. It is also used to pay claims and make what we call technical income or technical returns. Technical returns are basically just the difference between the contributions and the investment income that has come into the fund, minus all the expenses that the fund is supposed to be taking care of. So once the claims have all been taken out of this fund, what remains is what we call the technical income. What the uniqueness about this Mudarba model is that shareholders, as the operator of this fund, earn a Mudarib income or a management fee on this fund. But what distinguishes this from other models is that they also earn not just the Mudarib's fee on the fund, they also share in the technical results. The surplus that belongs to the participants actually, they share in those surplus, it's seen as their encouragement for them to make sure that this the technical returns are favorable or positive. Now, Sharia scholars, most Sharia scholars do not allow sharing of technical results, simply because they believe that this then violates or this transcends the Takaful model into a sale contract, where there is a commercial interest of the Sharia, of the Takaful operator in the returns. So then, remember we discussed the exploitative nature of pricing, we discussed the ownership of the fund. That becomes a bit vague. The Takaful, the Mudarba model is therefore not something that is in practice across the globe. It's diminishing in its stature, and it is the hybrid model that has evolved since then that really has become the predominant model in most jurisdictions. Let's talk about the hybrid model first, then we'll come to the Wakala. In the hybrid model, the policyholder makes the Takaful operator has two revenue streams. So first of all, the Takaful operator will get a wakala fee or an agent's fee on every premium that comes into the company. Every premium that comes into the company, the Takaful operator will deduct a small amount as his wakala or agency fee. Nothing wrong with that in terms of Sharia. Again, because it does not violate the violate the Sharia principles around a sale contract. The second revenue stream that the Takaful operator has is the same as in the Mudarba model, which is from managing the investments. This is called the Mudarba revenue or Mudarib's revenue. Here, the shareholders will share in the income coming from investments. So here you're looking at two types of incomes. One, the agency income. The other, the investment income or share of the investment income. They do not touch the technical income here. The technical underwriting surplus is there for the Takaful fund alone, and the Takaful operator has nothing to do with this Takaful surplus or the underwriting surplus. Some Takaful companies prefer to use some of the surplus and distribute amongst participants. Some Sharia scholars even have an objection to this. They believe that this Takaful fund was created through donations. So once I've donated something, then I do not have a further right to it. If a claim occurs, then yes, I'm a participant in the fund and I expect to be treated in accordance with the obligations of the participants. But if something is left in this fund at the end of the year, that amount belongs to the fund. It's a donation. It does not belong to me. Therefore, it cannot be distributed back to me. There are different schools of thought to this. Again, the shareholders are expected to contribute what we call the Karde Hasna facility. What is this Karde Hasna facility? It is put up on day one to get this fund started, up and running. Also, if there are shortfalls in this fund from day-to-day operations, then this Karde Hasna facility is it is the money of the shareholders, but it is offered as an interest-free loan to the fund, to the Takaful operators to make up for shortfalls or temporary shortfalls. And as soon as these shortfalls are then removed, the Karde Hasna is taken back by the shareholders. A third very common model is the Wakala model. And a similar model to this, which is the Wakala Waqf model, is what you have practiced in Pakistan, and also some operators in Dubai favor this Wakala Waqf model. The difference between the Wakala Waqf model and the other models are twofold. One, here the Takaful operator is expected not to provide a Karde Hasana, but to provide a Waqf or a donation upfront. So in the other models, there is a Karde Hasana that belongs to the shareholders, but is there to be used if there is any shortfall in the Takaful fund. But in this model, the shareholders donate this money into the fund. It's a Waqf. And they no longer own this Takaful. They no longer own this. The Takaful fund owns this. So this is one difference. The other difference is, again, revenue streams. Here, the Takaful operator or the shareholders do not share in the Mudarib or investment income. They definitely do not share in technical income or underwriting surplus, but they also do not share in investment income. The only income stream they have is from the agency fee. So every time I put up a premium, a percentage of that premium is taken as collection fee, agency fee, wakala fee by the shareholders. And their revenue model is all driven through this one revenue stream. This is, in a nutshell, this is the difference between the three models. Now, a number of different models have also evolved. For example, the cooperative model. Saudi Arabia, which forms about 56% or 57% of the overall industry, does not use any of these models. About 2 years back, the SAMA, the regulator there, they forced all the Takaful operators and conventional insurers to adopt a cooperative model. This cooperative model is, in the views of a number of Sharia scholars, again, not 100% Sharia compliant. because again the distinction between the Takaful fund and the Takaful operator becomes a bit hazy in this model. So the cooperative model, it's a model where again policyholders contribute towards a Takaful fund, but this Takaful fund is unfortunately owned by the insurance company. So the distinction, it becomes a sale contract again. Many Sharia scholars have their views that this is not 100% Sharia compliant. So these are some of the common models that are in practice these days. Any questions?
Thank you very much for the presentation. My name is April and I am going to start in Regency Hotel. So, it's really good to me. One pretty, not confusing, but it's basically a concern. The Takaful operator is the shareholder. The Takaful fund is the policyholder's fund, right? In case of solvency or in case of liquidation of the Takaful fund, which is the policyholder, then the shareholders are the ones which is the Takaful operator who have invested the capital. So legally they are ultimately or legally they are liable for settling all the claims and all the liabilities of that. So my question is, number one, how is the different contribution? In the end, it basically is ending up the shareholder. And number two question is, as you mentioned that it's to be paid back to the shareholder. The word itself says it's not to be paid back, it's a free loan. Now we are contemplating sort of a similar situation with CTP these days, and we're discussing whether we should pay it back or we should write it off. CTP says write it off. It's basically in the draft mode at the moment when we are in the finalization stage. So how would you differ, strictly speaking from the Sharia principle, that is a free loan, we don't ask for it, and of course it is interest free. And the Takaful Wakala model and the Hawk model, which explain that the difference is that the remains with the shareholders in the Takaful model, which is Bahrain, which is basically the Wakala structure. In the box structure, you are saying it goes, that stays with the policyholder funds. So basically, if you can address these two questions.
Okay. So,
one more point if I may add. The third thing is, from the IOC perspective, there is no treatment for Al-Hassan. How the accounting has to be done. So how would you propose that to be done or relate to that financial statement level?
okay. So one of the things I mentioned when we were going through the challenges of facing the industry is that regulations are evolving. Now, on the one hand, we have a 300-year-old insurance industry, and on the other, we have a 30-year-old Takaful industry. Not everything has been tried and tested in this industry as yet. On paper, in concept, your Takaful operator is not liable to pay any claims that come in if the Takaful fund is exhausted. Now, not many regulators will let the Takaful operator get away scotch-free. What happens in practice, and unfortunately, well, I wouldn't say unfortunately, fortunately, this has not been put to the test as yet, where the Takaful fund has gone into insolvency. So we've not really had an occasion where the regulator has had to step in and decide a case where the Takaful fund has collapsed, right? When such a thing happens, we will really have something to go on in terms of how the regulator reacts to such an instance.
Yeah, I'll just add one point here with regard to the exhaustive, you would say, and the ability of the Takaful fund, the policyholder fund to pay. You know very well in Bahrain, most of the companies, the Takaful operators, they have a capacity which is almost equal to the capital or it's almost the same. So in actual terms, if you see the company is going concern, you see the policyholder, it basically is it's not a going concern, but because of the Takaful operator having its capital, from the solvency-based perspective, it's continuing to carry on. So basically, it's a support. But if you see, It's going for a solvency issue.
Yeah. So you had two questions. The first one was around whether regulators would require that the Takaful operators make good any claims. Indications are that yes, they would require the Takaful operators to make good any claim, whether the Takaful fund is exhausted or not exhausted, whether the Karde Hasna is exhausted or not exhausted, but there's no proof as yet as to which course the regulator will take. On paper, the Takaful fund is responsible and the Takaful operator is not responsible unless there has been a negligence on the part of the Takaful operator. That's as far as Sharia ruling goes. As far as regulatory frameworks go, most regulatory frameworks are silent on this specific aspect. And they're silent not only on the Takaful side, but also on Islamic finance, Islamic banking side as well. On the Islamic banking side, although there has been a couple of cases where bankruptcy has been put to the test, and certain regulators have shown their inclination towards one or the other of the approaches. But in Takaful, we've not had such a case where a regulator has come in and said that you need to pay out all these claims, whether you have Takaful funds to take care of them or not. Your second one was around Qard and the treatment of Qard. Now, Qard is basically a benevolent loan. The definition of a loan is that you can take it back. And similarly, Sharia ruling on a Karde Hasna is that you can take it back. Now, if you cannot take it back, that's Waqf. That's Waqf, the Wakala Waqf model. Bahrain generally goes with the hybrid model, the model that we discussed, in the middle. But if you're saying that the regulator has requested you not to reclaim your Karde Hasna, I'd just say it's news to me. And right, it's under discussion, right? Okay, so had it been a Wakala Waqf model, then there would be no two questions about it. But in a Karde Hasna, generally you would, the Sharia ruling is that it can be reclaimed if there are underwriting surpluses and surpluses in future years. So I guess that addresses your question.
One more question. Last question.
Thank you very much. It was an eye-opening session. Credit goes to you. Before the session, I had no understanding about Takaful because this is not my area. Although I knew insurance because I used to get my car insured. And lately, when I started understanding a little bit of Quran, I started getting my car registered to Takaful, solidarity. And now, today I realize, and in substance, what I've seen, nothing has changed except that the company's name, to which I got my car insured. And with this presentation, I again think that nothing substantially has changed compared to what insurance offers and what we get through Takaful. And I still feel that I require to understand where that fundamental difference is. I had no visibility, it's still on the research phase as to what is not correct with insurance. But when you say insurance is not accepted by Sharia scholars, there would be some fundamentals. But when I see what Takaful offers, I get my car registered, insured, get the claims back, and nothing has changed substantially. And it's exactly the same for an end user. So, from Sharia people's perspective, my question is this prohibition for a person to get insured or a person to insure others' assets?
Can I just add to the same point?
he's addressing the exact same question I had. You can call it Takaful, you can call it insurance. You can show me the slide that you have just brought in, point to your point. But your donation will be based on the value of the car you're insuring. And you're still expecting a repayment if the car goes to us. You are still expecting the exactly same return. You don't know when the cash flow will happen, and you say, you exactly know that you're insured, so you don't have to worry about the car. What's changed? You may be, by the way, I think the only thing that has changed is the Takaful will charge me extra because it's summer.
No, it's a technical things. Technical is
Okay. So, again, very interesting questions. Let me just...
Can I just answer this? Just allow me quickly. Because I'm not insurance expert, I'm not an accounting expert, and he is. So when an expert talks, he talks in the terminology that sometimes can be more confusing. Allow me to talk like a layman's language. In the beginning, what he presented, he says, there is no issue in insuring. So the insurance as a concept is not haram or disallowed in Sharia. Am I right?
Yeah,
Okay. So once we don't have an insurance conceptual problem with it, Sharia doesn't disallow insurance. Then what else? Then is the practice that the insurance companies are doing. Some of the practices are not really compliant. For example, putting the money into some kind of investing the money into some kind of like interest-based securities, or putting into pubs and kind of thing, which is basically not allowed. So whatever the returns the insurance companies are getting from the investment is fundamentally not right. They are haram. And then when you distribute those income, it's also wrong. So the concern which the banks having, because this case, this question of what's the difference in the insurance and the Takaful, you can apply the same to the bank, conventional bank and Islamic banks. There is no difference. Literally. You go put the money and you get the loan, you get the mortgage, you get whatever the game you do. Islamic bank you do exactly the same what the conventional banking you do. It's only the way of approaching and doing the investment and getting the return and distributing is making the whole thing. Is it probably the right answer?
Absolutely. If I could, so when we began this presentation, I mentioned that understanding why conventional and why the Takaful are different requires us to understand why insurance is not allowed in the first place. And we just heard once again that there's nothing wrong with the concept of insurance. If you have a hamburger from McDonald's here in Bahrain and from in the UK, the end product is exactly the same. It's actually the back-end processes that have changed. So just like that analogy, there's nothing wrong with mitigating your risks as such. And similarly, there's nothing wrong in a number of things that insurance companies do. And therefore, if the Takaful companies do the same, there's nothing wrong with them either. Let's look at what insurance companies do, which we should not be doing. Okay? We talked about riba-based investments. So we all agree that riba-based investments and Sharia-compliant investments, that is investments that do not yield interest, there's a stark difference between the two. Do we agree or do we not agree? At least to this point? Okay. Secondly, in insurance, the company is liable to pay your claims. Therefore, it's a case where you are exploiting one party or the other. One party's loss is dependent on the other party's gain. Now, on paper at least, this is not supposed to happen on the Takaful side. If a Takaful fund is exhausted, like I said before, on paper, if a Takaful fund is exhausted, then it is not the responsibility of the Takaful operator to make good any claims. This is again one of the fundamental differences between the Takaful and conventional insurance. In insurance, your insurance company is getting into speculation and gambling, hoping that the premiums they are charging will yield profit for them at the end. In the Takaful fund, the premiums that you are charging are not speculative because they're not supposed to yield you a profit at the end. You are not supposed to take anything in your pocket from underwriting surplus. Meaning to say that if there is a difference between the premiums that are being brought in and the claims that are being paid out, that difference is not there for your shareholders to pocket at all. There lies the fundamental difference. So, where on one hand you have a donation-based system where you are pooling in money, and I'm sure many of us do this informally in a number of different ways. Pooling in money and making that pool available to all participants. That's the concept. Now, you might have challenges on the practice of the Takaful, and like I said, we discussed, let's say, 5 models, and out of those 5 models, I put my hand up and I said, 2 of those models have severe Sharia concerns. 3 of those are evolving scenarios where Sharia concerns are gradually being addressed over a period of time. So yes, there is a lot of there's a lot of learning for these Sharia for these Takaful operators to undergo, but it's a step in the right direction. It's a fundamental step in the right direction, and there are a number of reasons why where Takaful has sort of got rid of Sharia repugnant elements in its operations. Yeah.
Great, you guys did in Sharia compliance of Takaful. We are reinsuring the declaration reinsurance company. That is also a concern. But as you said, it is only 30 years lag, and we have to wait how to develop it. But I've been in this field the last 8 years. I don't see that any reinsurance company is coming up as a Islamic Sharia compliant company.
Okay, so allow me to just address it. About 10 years back, around 10 years back, this used to be another challenge put forward to, first of all, to Islamic financial services. They used to say if you're getting a car on Islamic finance, you're still getting insurance from a conventional insurer. Then where's the Sharia compliance then? However, this was 10-15 years back when the Takaful operators were not really there to support the needs of the Islamic finance industry. So now that the Takaful operators are there in abundance, Islamic banks have more or less discontinued this practice. Similarly for re-Takaful operators. Initially, Takaful did not have the re-Takaful operators to, with enough capacity to back their operations. And Sharia scholars requiring re-Takaful arrangements or reinsurance arrangements to take this industry forward had given the leeway till the time that the re-Takaful companies come up. You are free to do your reinsurance. Now that has changed. There are the Munich Re's of this world, the Swiss Re's, the ACR Re's. All these reinsurance companies have huge re-Takaful businesses as well. So if there's any insurance company that says there's not re-Takaful capacity existing today, that may be misleading. There is plenty of capacity. In fact, some of our clients from the re-Takaful industry have this complaint of grievance with the Takaful industry that now the capacity is there, but it's not being availed, and reinsurance is being availed in its place. But again, this is all a learning curve, and gradually you will see that these shortcomings, will be removed going forward, hopefully.
Thank you. Everybody hear me in the back? Good? So thanks a lot. I think that session was great. Normally, even I learned quite a bit. The very interesting thing on valuations is quite contrary to Takaful is I've been doing valuations for the last 15 years. And to be honest, I don't think too much has changed, especially in terms of the fundamentals of valuation. So that's a good thing. What has changed is the accounting treatments of what we talk about valuations. Now it's getting more and more, probably more prescriptive, more descriptive in terms of how we have to portray valuations and fair values in our financial statements. So what I'll do is, this session is, and we talked about the length of the sessions. We'll try and focus on fair value. We'll try and focus on some of the major concepts in fair valuation and some of the big challenges that we see from a practical perspective in terms of fair valuation. Like, I do have a lot of slides which talks about the technicalities of valuations. I do think those sessions can sometimes, we do sessions about 2 days, 3-day sessions on technicals. So please don't expect to walk out of here technically totally competent in valuation. That's not what this session is about. We'll try and bring out the concepts, the challenges, and the issues that come about. Just by the way of background, I'm a director in Deloitte in the valuation practice. I've done valuations for about 15 years. I was in the valuation group of Ernst & Young in South Africa and Canada. Now I've been based in the Middle East for the last 3 years with Deloitte. And like I said, I've done a lot of valuations. I value companies, I value assets, intangibles. And when you go down to the bottom of it, the fundamental approaches in valuing businesses or assets or intangibles are not indifferent to each other. It's just how you apply that approach. So now, let's talk. So we'll spend about 10-15 minutes on fair value and IFRS 13, which is a new concept that is coming in terms of fair valuation. It has been around and it has been kicked around for a long time in North America. I think it's now coming into this region quite forcefully. Starting January 1, 2013 is what the effective implementation date was for IFRS 13, for companies to adopt IFRS 13. IFRS 13 always had a definition on valuations. And what IFRS 13 did talk about was, it talked about fair value. We're talking about this, fair value. It's the amount at which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's length transaction. Right? So essentially what it's saying is, the price at which you transact, if you're an arm's length party, that's fair value. That was the old definition. So now, if I take a simple example, I run a lot, and I always give this example, like if we have a bottle of water, we know that the small bottle of water, not these big ones, probably the small one is maybe 1 dirham, right? You can get it in the market. That's a common fair value of that bottle of water. Now, 2 weeks ago, I was doing the Jordan Ultra Marathon, and I actually ran out of water. And the next watering station was still about 5 kilometers away. At that point of time, I would have paid somebody maybe 50 dirhams to get a bottle of water. And that person is not related to me. So it's an arm's length transaction. Is that fair value? So, probably is not. We all know that the fair value is 1. At that point, I did a transaction with somebody because I was in dire need for water at 50. It's arm's length, knowledgeable parties. He knew I was in need of water. I knew I needed water. I knew he was charging me 50 and I paid 50 for it. Or I would have paid 50 for it. So now comes a new definition of fair value. What it's saying is it's the price at which would be received to sell an asset or pay to transfer liability in an orderly transaction between market participants as at a particular date. So that's the biggest change in fair value definition. So now what IFRS 13 has really said is bring the market into play. Now, if every runner in that race was like me, for the 2,000 participants, and we all didn't have water, and we all were willing to make a transaction, somebody could argue that maybe that's a market at that particular point in time. Right? So when we come to value businesses now, bringing it back to businesses, we always have this concept where somebody will want a business value and you'll say, come and do an independent valuation, and by the way, I think it's somewhere around 20 million and that's where you end up. And the person is thinking from his point of view, being the operator of the business, that maybe this business is worth 200 or 100 million because this person is going to buy me. He can save some cost based on his existing business. So he's going to make money. Maybe my business is worth 80, he's going to save 20, so I think he should pay me 100. That is, once again, talking into the concept, it is the 20 is coming from the buyer's specific buyer because he can make those synergies. What you have to think about is, can everybody in the market who would be in the market to buy this business, can everybody save that 20 million and add 20 million of additional value to that business? If the answer is yes, then your fair value is 100. If the answer is no, one person will pay you 20 million extra, the rest, everybody in the market will pay you 80, the fair value is 80. Right? So that's the biggest difference, the market participant. The second is orderly transaction. Once again, what is orderly transaction? If I'm looking at a fire sale, let's say I have a business and I'm in desperate need of money, I'd be willing to sell it off for cash at relatively cheaper than market because I have liquidity problems. That, if it is not an orderly transaction, it could be argued that it's not fair value. Where such a transaction could become fair value is if the company is in trouble and every other buyer in the market knows that, and every other buyer in the market would pay you less than market. And you have enough time to create that transaction while you're in liquidation. It is orderly transaction because it's done over a process of time. It is representative of fair value. Right? So you have to have a market, you have to have orderly transaction, and you have to have as at a particular date. I did have a question last week where we were doing evaluation, and at the last meeting where we were being awarded the contract, everything was done and they said, okay, you're awarded the contract. And the chairman, just before leaving, he looked at me and said, how long is your report going to be valid for? And the answer to that is, it is valid as at that date. The value is as at that particular date. Something could happen after that date, which could shoot up the value or completely drop the value. Like, so I, as a valuator, cannot predict that. To be honest, if I could predict that, I'd be doing a lot more other things than working for Deloitte as a valuator. Right? I'd probably be somebody like Warren Buffett trying to pull up synergies and strategies and thoughts from around the market and say, this is the value of the stock that I'm going into and that's where I'm going to make money. But the truth of the matter is, like, and that's where one of my closing points is, we always talk about valuation being an art, not really a science. People always think about valuation being a number. 10 million EBITDA, 5 times multiples, my business is worth 50. It is not that. Yes, the math works like that, but you need to understand if that 10 million is representative of the 10 million going forward. 10 million might be because you had a bumper year last year. Or 10 million might be because you had a worse year last year. You generally are around 20. 5 multiple has to make sense. Just because businesses around you sold at 5 times multiple doesn't mean that you necessarily will get a 5 times multiple. You might get 4, or you could be in a position to get 7. I have a lot of things where we're going to, where discounted cash flow is the most common valuation approach that everybody likes to use, because it really depicts your cash flow position of the company, forecasts the cash flows out. And a lot of times, the first thing they will come back and they will challenge you on the discount rate. And they will say, well, my business should not be at a 12% discount rate, you should do it at 11%. Why? Because if I use a lower discount rate, the value goes up. That's what everybody wants, a higher value. But the truth of the matter is, just because I change the discount rate, the math is going to work fine and the value is going to go up. But does that value make sense? And that's why one of the other things we do is, and I always say is, as you people in the industry, everybody looks at valuation reports. If you hire a third-party valuator, or anybody, and they give you a valuation based on one approach, the first question to ask is, how do you support that approach? Have you looked at an alternative approach? Sometimes people will say, I cannot do any alternative approach. Well, fine then, tell me reasonability, how does that make sense? Or you will have a second scenario where you have valuators that will do 3 different approaches. You have 50 million, 60 million, and 200 million, and they will average the 3 and say, here's the value. That is also wrong. The key thing I always say is, when you're doing a valuation, when you're doing a fair value or a market valuation, the most appropriate thing is to do is choose your primary approach. Based on your asset, based on your type of business, my primary approach is going to be either cost, market, or income. And I'll talk about those three approaches briefly in a minute. Once you've chosen your primary approach, which will be based on what your business is stated at, then you test it or assess it for reasonability based on a secondary approach. Then you make sense that you've done your research, or somebody's done their work, and before they come into a conclusion, it's not just a mathematical exercise of coming up with a number. We all have Excel. We all can do that. Right? So anyway, just coming back to fair value and coming back to IFRS 13, the biggest things that changes in terms of definition is you now have to have a mindset of having a market, thinking about the market. You have to have a particular date of valuation. You have to think about an exit price. Now, does the exit price change a lot of things or not? Like if you think about the previous definition of fair value under IFRS 13, just talked about a price at which a transaction takes place. Now they talk about a price that would be received to sell an asset. So you have to make an assumption that the asset that you're thinking about will be sold or somebody is going to exit from that position. I personally feel it doesn't change the answer. All IFRS 13 is saying is start from the end point, from the sale point, and then bring it back, make adjustments to see where you come to fair value. So for example, if I'm selling my house, I want 200 million. Somebody else is willing to pay me 100. I don't know what the price is, but you need to make an analysis. So what IFRS 13 is saying is you have to start thinking from the 200 million coming downwards. Now, when we talk about market participants, and we touched on these things briefly, but what we're talking about is what they say is what is a market? It has to be the most advantageous market and the principal market. The advantageous market is, if you're in the business, you're obviously in a business, you're there to make money. You're there to make returns on your investment. So you will choose the most advantageous market for you, is the market that's going to make you the most money. It has to be the most market. The principal market is, you will choose a market which has the biggest volume. So between the two, combination of return and volume, or profitability and volume.
It was a very massive, detailed presentation. With this, we have reached to a what a wonderful evening we had, good audience, quite a lot of engagement with us. But before I put a full stop to this lovely conference, I would like to do a few announcements here. This ICMA, Institute Cost Management Company of Pakistan, they have reached to with our forums a principal understanding that they would like to conduct examination here in Bali. Our forum will be conducting that. So, if you know anybody who is already a student or want to be a student, take admission, contact me. If you have a minimum of 10 students who need to give exam, then the ICMA will be conducting exams here in Bali. The second thing is that I will, after this forum, maybe next week, we will circulate an evaluation form for this conference. Just to understand us better, what happened in the conference, whether we need, what area we need to further improve, and to reach to your expectation having gone. Next conference we are planning to have in June, end of June. Most probably before everybody goes on leave, on school vacation. The good news is that we will try to have the next conference sponsored, so you don't have to pay for that. It is 99% confirmed, but we will let you know that how it goes. I will request you to, and I will myself request along with you to thank to the board of this forum. Without their effort, this whole conference would not have been possible. So I would like to thank for the board members And I will also request you, if you can please, before you leave your cards on this table. It will help us better knowing each other and to have a better database of the members. Dinner is about to start. That's the good news. So you don't have to wait further. People are working on it, and in 2-3 minutes it will be done. Is there any question that you would like to ask?
Thank you. I have a question from Manish. Please, you want to answer the question? Yeah. You can hear me properly. How do you evaluate a particular asset or anything?